My colleague Joe Fiorica actually published a great piece on this, breaking down the rally that we saw off the lows in June and July. He published this at the beginning of August and reasons to remain cautious on it. So the first point, which really gets to this concept of short covering, was there was very bearish positioning that had exacerbated moderately positive news. And that bearish positioning we saw across both institutional clients as well as retail clients. So when we're looking at how bearish the market was, I mean, this was the worst start to the year in history when you look at both equities and fixed income declining in tandem by more than 10%. That hasn't happened. You saw a lot of the reports around it was one of the worst starts to the year on record for the 60-40 portfolio. And so U.S. equity futures, when we saw net short positions, they reached their highest levels in over 10 years. So what happened? A lot of people thought that maybe the worst was priced in. Maybe we kind of overdid this sell-off and that there is some positive news coming, or that we've already priced in the damage that was done from a bear market. So we saw that. And then we saw really resilient Q2 earnings. So we saw resilient Q2 earnings, some top line revenue growth, which surprised to the upside. And the market took that and continued to rally. I think the one piece, though, and this goes back to what Chair Powell said on Friday and really reiterated, is the fact that people were starting to try to find dovish signals in what the Fed was saying. And we didn't buy that. I think the Fed has been very resolute on what they're doing, why they're doing it, and that they're going to continue on a hawkish path. And so I think Friday basically eliminated any of that ambiguity.
So you were just basically saying that players had been set up short with indexes or whatever. It was kind of a generic comment that people were positioned for a market sell-off when it doesn't happen.
People were positioned, expecting it, exactly.
It had nothing to do with meme stocks or short this, short. It was just, I said to someone yesterday that on Market Watch, when they don't know why the market goes up on any given day, they say short covering. Short covering is the most common reason for a market advance that people have been, I've heard it 10,000 times in my career, I would say. So I don't understand the whole notion, but it's a very good point. People were positioned from June 16th, probably short, and so there was some covering, and that had to do with that. Now, talk about.
And actually, if you look at what you were saying earlier, just in terms of the VIX being relatively muted, right? So when we look at a week like this, and we saw yesterday some continued sell-off, today futures look positive. I mean, paying a lot of credence to the market action that we're seeing this week, right, day over day. You're talking about markets are thin, people are on vacation, and actually patience is required. Investors are in a little bit of a wait and see mode with light volumes, cash on the sidelines, as the market is really awaiting what's going to happen on Friday with jobs data, and also what's going to happen with CPI data on September 13th. So this is a market that requires patience, and I think paying too much attention to some of these day-over-day movements could actually get you into a little bit of trouble.
Do you think, Kristen, that we go to new lows below 3,600, or you don't? I mean, it's a fool's errand to even try and figure things like that out. But would you be buying on dips at this point, or would you be selling on strength at this point for, let's say, the next 3 or 4 months?
So for the next 3 or 4 months, we've actually been preparing our portfolios for this. And I think the one thing that the market is not pricing in, and we have to be really honest about this, is everyone was looking at what is the Fed going to do? Is there a pivot in the Fed? That's been taken off the table, at least looking through to the rest of this year. And so I think that the conversation is really going to pivot from one focused on the Fed to one focused on earnings. And in Q2 earnings, when we think about the impact of tightening on the market, we shouldn't have really seen that in Q2 earnings. The impact of financial tightening, both through rate hikes as well as quantitative tightening, is something that has some delay. It can be anywhere from 12 to 18 months. And we've done some pretty seismic shifts in terms of rate hikes already. And so how that flows through to future earnings is going to be critically important to the direction of markets. It's going to impact consumer behavior from a spending standpoint. It's going to impact corporations' behavior. And so the strategy for here is really quality and balance, both when it comes to equities as well as fixed income.